Hello everybody, and welcome back to chapter 11 in our first video here. In this chapter we're going to be looking at intangible assets. And so our learning objectives are discussing the characteristics, valuation, and amortization of intangible assets. Number 2, discuss the accounting and financial statement presentation for the various types of intangible assets. Number 3, explain the accounting issues for recording goodwill. And lastly, number 4, describing the accounting and presentation for research and development and similar such costs. Okay, let's take a look at an overview of Chapter 11. Here we're going to look at the characteristics, valuation, and amortization of intangible assets. And we're going to take a look at the kinds and types of intangibles. We have marketing related, customer related, artistic related, contract related, technology related, and finally how we present those different types of intangibles. We'll spend a little time in this chapter looking at a specialized intangible asset called goodwill, how we record it, how we impair it if it needs impairing, how we might have a bargain purchase, and how we present it. R&D costs, yet another kind of intangible asset, specialized, and here we'll be identifying R&D, accounting for R&D, similar costs associated with research and development, and finally our presentation. All right, let's get into the meat of the chapter. Here we're going to be discussing the characteristics, valuation, and amortization of intangible assets. Intangible assets are assets that lack physical substance or existence. You can't physically touch them with your fingers, right? They're not financial instruments, and they're normally classified as long-term assets because we don't usually expect to sell them or get rid of them at any point in time. So we're going to be keeping them for the long term. Okay, common types of intangibles include patents, copyrights, franchises or licenses, trademarks or trade names, and finally goodwill. The Coca-Cola Company's success comes from its secret formula for making Coca-Cola, not its plant facilities. So, how do we value the purchased intangibles? If we purchase them, we're going to record them at cost, and we're going to include all the costs necessary to bring that intangible asset ready for its intended use. Typical costs will include the purchase price, legal fees, and some other incidental expenses. If we internally create the intangibles, we're going to record those at cost, and instead of capitalizing them, we're going to generally expense that. We only capitalize direct costs incurred in developing the intangibles, such as legal costs. And our underlying concepts, the controversy surrounding the accounting for R&D expenditures reflects a debate about whether such expenditures meet the definition of an asset. If so, then an expense all R&D costs policy results in overstated expenses and understated assets. When I first started in accounting, we did in fact capitalize R&D. Now that's changed dramatically as of the early 2000s. So we generally expense R&D costs. Sorry for that. The PowerPoint had a mind of its own there. Okay, so now limited life intangibles. Now, not all intangibles have a limited life. Some of them have an unlimited life. The example I use for unlimited life would be something like the Nike swooshes copyright or trademark, I should say. That trademark is gained in value over the years. Everybody recognizes that Nike swoosh, and it looks like it's an artist depiction of the wing of the god Nike. It looks like a giant check mark, and it's extremely well recognized, and it's not losing any value. It's an unlimited life trademark. However, some intangibles don't have a unlimited life. If they do have a limited life, then we're going to amortize the expense over the useful life, credit an asset account, or an accumulated amortization account. Generally, companies credit the asset account as opposed to depreciation, where we usually credit the accumulated depreciation account. But in the case of intangibles, you have the choice of doing either. The useful life should reflect the periods over which the asset's going to contribute to our cash flows. And amortization should be cost less the residual value, just like we do for depreciation. Companies should evaluate limited life intangibles for impairment, and we'll talk more about that in this chapter. All right. Amortization of a license example. Here, Limited Wave purchases a license to provide a specified quantity of a gene product called Mega. Second Wave should amortize the cost of the license following the pattern of use of Mega. If Second Wave's license calls for it to provide 30% of the total first year, 20% of the second year, and 10% per year until the license expires, it would amortize the license cost using that pattern. Okay, if the cost of Mega is $1 million, what is the amount of the amortization expense reported in the first and second year? And then prepare journal entries to record the purchase and the amortization in the first and second years. Okay, so if we were to purchase this license, we're going to debit licenses, an asset, for $1 million and credit cash to pay for it. And because of the pattern that was in the problem, we're going to take 30% of that $1 million in the first year, and that's going to be charged to amortization expense. Notice here, they're crediting licenses instead of a accumulated depreciation account or accumulated amortization account. This is by far the most common way of amortizing intangibles. So in the second year, it was 20%, so we're going to do the same thing. And at the end of the second year, then the balance in the licenses account is going to be $500,000. And note that when amortizing intangible assets, just as I mentioned, companies typically credit the asset directly instead of crediting an accumulated amortization account. For your homework problems, let's be sure to credit the asset account directly and not use an accumulated amortization account. Okay, a U2D company has an intangible asset of $400,000 related to its Real Soup brand name, which it sells to wholesalers. The brand has an estimated useful life of 10 years. One of U2D's wholesalers, Hadley Company, commits to purchasing this brand name for $160,000 at the end of 8 years. How should you record the amortization of the Real Soup brand in the first year? Well, for the solution, the computation of amortization in the first year is going to be $30,000. That's the 400,000. Let's go back. The 400,000 here, less the 160,000 that you're going to sell as a residual value to Hadley. And that we're going to divide by the 8 years. So U2D reduces the cost of the intangible by its residual value for purposes of amortizing the brand. Since U2D will be selling the asset at the end of 8 years, it uses 8 years as its useful life rather than 10 years. The entry to record amortization of Real Soup brand in the first year, we're going to have amortization expense, and the credit is going to be to its brand. You could, of course, do accumulated amortization, but that's rare. All right. Impairment of limited life intangibles. The rules that apply to impairments of property, plant, and equipment also apply to limited life intangibles. A company should review limited life intangibles for impairment at certain points, specifically whenever events or changes in circumstances indicate that the carrying amount of the asset may not be recoverable. So we'll recall that two-step process for determining if there's an impairment. The first one is the recoverability test. The company estimates the future cash flows, undiscounted, expected from the use of the asset and its eventual disposal, then makes the following comparison and conclusions. If the sum of the expected future cash flows is greater than the carrying value of the intangible asset, then there is no impairment. But if the sum of the expected future cash flows is less than the carrying value of the intangible asset, there is an impairment loss. If the conclusion is that there is an impairment, the company continues on to the fair value test. Number 2, fair value test. If the intangible asset is impaired and the impairment amount is calculated as follows. We'll take the carrying value of the intangible asset minus its fair value, and that will give you your impairment loss. Okay. Here we're talking about the Lighthouse Company, and it has a patent on programmable home lighting systems. Unfortunately, advances in smart home technology adversely affected the demand for its programmable systems. Thus, the patent has provided little income to date. As a result, Lighthouse performs the recoverability tests and finds that the expected future cash flows from this patent are $35 million. The present value from the expected cash flows is $20 million. Lighthouse's patent has a carrying amount of $60 million. How would you compute the impairment loss, and what is the entry to record this loss? This looks like a good place for us to stop this video, and when we return, we'll look to the solution of this patent example. Until then, bye for now.